What up? Hello. Yeah. Please, as I promised, I'm going to give you a live video of this strategy so you know how it works in real time. My name is Prince. I'm a currency trader. I trade forex, spot forex. Actually, I base on the fiat currencies. I also trade virtual currencies like cryptos in some cases, in sometimes. So on this particular recording, I'm going to show you how I trade currencies, how I make a lot of pips, how I make about 1,000 pips a week, a month with this strategy. Yeah, please, this is not a holy grail strategy. I did some little work before I can find my edge on the market. But I can assure you that this strategy is one of a million. So let's get to how this strategy works. First of all, I'm going to try to introduce the market in case you're a beginner. But actually, the book wrote everything. I wrote everything about the markets. I wrote everything about currency trading. I wrote everything about my strategy. Okay, so if you don't know the background, you might as well go back and check on that book and go through that book before you listen to this video because this video is actually going to cover just um, the strategy. That's the bank trading strategy. That's the only thing I'm going to talk about here. I'm just assuming that you've actually gone through that book because there are some terminologies that I'll be saying or I'll be using that you might not get, you might not be accustomed to. So if you go through the books, all those things are written, all those things are well explained. So I suggest you go through the book before you start this recording or start viewing these things. Now, the financial markets, the global financial markets is actually a place where traders worldwide meet to facilitate trading, to buy and sell. Yeah, as we all know in the markets, what we actually do is to buy and to sell. There is no other thing. We are exchanging one currency to another in terms of forex. In terms of commodities indices, we are exchanging the products, that's the instrument, with its value in cash. Okay, we are exchanging it in its value. Let's say gold, we are exchanging gold with the value in US dollar. So everything we're doing is exchange. We are trading means we are getting something in return. We are buying or we are selling. We are giving and receiving with the purpose of making profits in the market. So currency trading is basically trading money, yeah, trading currencies that are used as a medium of exchange around the world. There are major currencies, there are minor currencies, and also there are exotic currencies. But all of these things don't matter. What matters is that we use the major currencies to trade the markets, which are the USD, the Euro, the GBP, the Japanese yen, and all the rest of them. And again, all these things are explained in the book. Yes. So I'm just going to give a quick introduction, then I dive into the strategy. Yes. So currencies are traded by two countries, one country and the other. We exchange them. One is the major, one is the minor, or one is the quote currencies, so to speak. The base currencies are the ones that has the value, while the quote currencies are the prices of the base currencies. So let's leave it to that. Now, the market is actually owned by two players, the market makers and the retail traders. Market makers consist of the people who has higher funds in moving the markets. They are called the smart money, or they are called the big players in the market. These people are characterized by the investment banks, the hedge funds, the institutional traders, and the big individuals like the Bill Gates, the Zuckerbergs. These are the big players who has a lot of funds to move markets, while the retail traders are just people who come there to make profits, who come there to just take a little bit of the profits, not actually the big traders in the market. Yes. So the retail traders are on the other side, while the big players are on the other side. So these big players don't actually use a broker, while retail traders, we need a broker to access the market. So these brokerage firms, they are organizations that serves as intermediators against we and the market. That's the retail traders and the global financial markets. They give us financial instruments, they give us access to these instruments, they give us leverage, and also they take charge of our capital, they save our capital security, and also they make it available for us to access our funds. So the brokers are the ones who give us leverage to participate in the market. Usually in the global financial markets, you're supposed to have at least 100,000 US dollars to participate. But in this case, retail traders don't have that kind of funds. So the brokers are those who give us access, give us leverage to participate in this global financial market. Yes. So the investment bank are actually the people who play the demand and supply of the market, because our strategy is going to be based on the demand and supply concepts. Yes, it's just like economics, it's just like any other market in the world. It is based on demand and supply. When the demand is high for a particular instrument, the prices tend to go high. While the supply is very high, the prices tend to go low. The more buyers in the market, the more the price increases, and the more sellers in the market, the more the price reduces. So we make profits actually when we buy and the price moves up. If we buy at a certain price and the price goes up, we make profits. While if we sell at a certain price of the market and the price goes down, we make profit as well. That is speculation. Unlike stocks and indices, you only have to place your trade, your buy trade, and hope for it to appreciate. While in the currency markets and the spot forex markets, you can buy and you can sell as well. So let's give you a bit of an example here. So let's say here is the euro against the dollar. Like I rightly said, every currency comes in pair because we are exchanging one currency to the other. The quote currency determines the price of the base currency. Every of these things are all in the book I've given to you. Okay, so this is Euro USD. Let's say we are buying at the price of 50 USD per euro. Let's say the price is 50 and we click our buy. So excuse me. So when this market goes up, let's say to you bought at $50 and the market moves to sorry, what's happening here? Yeah, what the hell is happening here? Yeah, hold on a bit, please. So yeah, let's continue. Let's use this. You bought at the rate of $50 per euro, and price moves up to, let's say, $100. As you can see, he made a total profit of extra 50 USD for buying this amount. All right. So as you already know, we can't actually buy 50 worth of USD and expect to make that amount. There is always the bigger picture of it. If you go to the currency markets, the USD price and euro are at slight equilibrium. So when you buy 1 unit of euro to dollar, you won't make a much of that profit. That is why the brokers are offering us leverage, a lot of huge funds for us to participate so that we can make a significant amount of money. I'm just telling you how we make profits. When we buy at 50 and $50 and price increases to $100, we've made again a profit of 50 extra dollar plus our capital. All right. So the same thing happens on a sell scenario. When we sell and price goes down, and yes, about we'll make our profit also. So whether we are buying or we're selling, we are making profits. But the big question here is, how exactly do we know when to buy so that we can make profit, and when to sell for price to go down so that we can make also profit? So that is what fundamentals and technical analysis are here to tell you. Fundamentals talks about the general economic concepts about the particular currency pair, because currencies are the reflection of the general market or the general country's economy. So currency reflects the value of an economy. The US dollar reflects the value of the economy of the United States. I hope you already know this. And the euro reflects the value of the economy of the Europeans or euro. All right. So these are, how do we actually know when exactly to buy? And we say fundamentals. Fundamentals are just news, the global economic data and economic news about how a particular country and its economy is going. We have a lot of news, we have a lot of fundamentals, we have a lot of um, economic analysis that we can find out in some other websites or even in CNN or any other news websites that talks about the forex or foreign exchange of the global financial markets. But regardless, we use technical to bypass a lot of things, a lot of all these economics, because most of us are not into economics in details, right? So whether or not we know all of that, we also make money. It is good to use the both, but fundamentals is just how the market moves, while technical is how the market has moved in the past. So we are using the price past action to predict future price reactions. So that is just what we do in technical analysis, repeating the past price movements and applying them in the future to determine where the price goes, whether up or down. So this strategy is not that so hard to understand. It's very simple. And that is why I've chosen to analyze this in front of the screen so that you understand how it goes. Yes, let's dive into this amazing strategy. It can be understood by beginners, advanced, any level of expertise in this industry, you can understand it. Please, I've done a lot of research about this, and I can confidently tell you that this strategy gives at least around 70% win ratio in the market. Yes, and it can actually give you consistency you need in this financial market. Let's dive into it. I'm going to be sharing my screen, and I really need you to hold on a bit. Yeah, as I rightly told you before, uh, this strategy talks about the, the demand and supply in the market. The higher the demand, the higher the price goes, while the lower the demand, the lower the price goes. So just like in every other market you see around there is always a demand and a supply in the market. So who are actually moving these markets? They are the investment banks, the hedge funds, the institutional traders, because these are the people who has a lot of funds to move markets. They can invest in 100,000, $1 million, um, 2 million, $1 billion in the markets, while we follow their footprints. We follow the footprints of these people. We do not predict or we do not make any impact in the movement of the market. So let's see. So when you get your charts, whether your currency, whether your spot forex, whether it is fiat currencies or cryptocurrencies, all you have to do is go to the higher picture, like we said in the book. We go do some top-down analysis. We go from the higher time frame perspective, then understand the flow of the market first. You have to determine the trend. Remember, every forex book there tells you that the trend is your friend. Yeah, it is true. You have to trade in the direction of the trend. So first, we are going to look at two things in this strategy. Number one is to understand where to trade. First is to understand where to trade. That is whether to buy or to sell. Secondly, is to understand when exactly to trade. Yes, when exactly to enter your buy or sell. Like we asked before, we already know that we'll buy when the price is low and sell when the price is high. So when exactly do we know that this price is low for us to buy? And when exactly do we know that the price is high for us to sell? And secondly, where do we trade to? That is what we're going to look at now. The first is to know the flow, the bigger picture of the market, to understand the buyers and the sellers who are more in charge. Like we talked about the demand and supply, the more buyers are in the market, the more price goes up. So we must know which of the parties are more in the market. So we do that by going to the higher time frame. As you can see, your chart might look a little bit choppy like this. Sometimes you come to the market, you come to the chart like this, looks like you don't even understand what you're doing again, right? Yeah, it does something like that. So this is the chart. This is all about the Australian dollar and the United States dollar. So the Australian dollar is quoted against the United States dollar as the base currency. So this is its all monthly time frame. Zoomed in. This is my chart zoomed in on Australian dollar, United States. So I'm going to be deleting everything here. So this is the first chart. When we come to the chart like this, and mind you, this platform we're using is called TradingView. We use it because it provides us more convenience in trading against other trading platforms. We can see the future and we can see the past very well because we are trading technicals, and technicals must deal with seeing the future and predicting the future using the past. So the trading view gives you that access to see everything about the market. So we are in the monthly view now. First thing you have to understand is you don't actually make any decision in the monthly time frame. What you do exactly in the monthly time frame is to understand how this market has formed right from inception, right from 2003, yes, and to 2022. 2022, yes. So another thing you understand in this market is that these prices, all these prices you're seeing here, are plotted against time. This is, let's say this is a graph. Yes, we see the time are plotted. These are the year 2002, 2011, 2019, 2027, and all the rest of them. These are time and these are prices. What is it telling us? That all this information, how prices has moved, any level of price, there must be, at any level of price, there must be time in it. So there must be a time representation of every damn level of price, you know? So this is it. So there must be time representation at every given level of price. So we use the past information based on the time to determine what exactly is going to happen in the future and at what time. That is why we have the time frames around there. We have the monthly, we have the daily, we have weekly, 4 hours, we have H1, have 1 hour, have 30 minutes, 45, 50 minutes, and down to 1 minute, which is the list of the time interval we are trading on. So when we come to the monthly time frame, how to understand how the market has moved over time from the starting 2007 to January 2000. sorry, 2003 to January 2004. Sorry, February, yeah, July 2004. This price has been moving up. So, meaning that there is a lot of demand at this particular area of price. There is a lot of demand. At this particular area of price moved up, meaning that the buyers are more in charge in this area. All right. So at this level, price begins to make a little bit of retracement, or do we say correction? It's corrected itself a little bit. Yeah. So as price moved up, telling us that the buyers are in charge, it came back a little bit. And what you have to understand is correction is always a constant thing in the market. There must be a correction. It is retracement. Every buyer, every person looking to buy must at one point want to take profits. So when they are taking profits, they are doing opposite of what they've done in time. So the big banks at this time, they entered, the buyers particularly were in charge. They went to this the level of 0.7950 price, and they decided to take some of their profits. They moved away some money, and it's caused reaction in the market, making this price to go a little bit down. So they resumed again and came back here, and they didn't push further. They retraced a little bit again. So this whole moves, we are just profit taking. So at this time, they resumed the market. A lot of buyers came again. They outnumbers the little sellers who are taking profits because they knew that this market is going to go up. So they went up here. They moved to 1.0. 1.0 at this point, one United States dollar is not equal to one Australian dollar. So the price is equal. At this point, the sellers find it more relevant or more interesting to take on this market. So they've actually bought all the way to this point. It is time for them to make a huge amount of profits by selling these instruments. And at this point, some buyers are no longer actually willing to buy. So that caused a lot of big move. It moved down. And we can always also say this is actually the investment bank selling this market at this point. So due to the fact that this instrument was still okay, it was still new, yeah, the buyers are also willing to move this market a little bit higher. So I'm just trying to analyze the bigger time frame perspective here. But when you get to this level, you're not always going to be doing this, right? So at this point, the buyers pushed the market again, resuming the previous trend. So when they got to 1.089 price, they had to move. The sellers had to come here massively. Remember, the more the sellers, the more the price goes down. So sellers came and outnumbered the buyers, and this price went a bit down, breaching the last low of the market. The last low of the market. So at the monthly time frame, we understand now that the sellers are the ones in charge of this market. But when they came down, the buyers took advantage of it. The buyers pushed price higher up to this level and they couldn't break it any longer, right? So this AUD USD is now trapped in a little consolidation range. So we also call this a correction, the forex market. Price might go lower, price might go higher, but at this point, price has established the highs and the lows and has already left the high coming down to this level. So the higher time frame, monthly time frame has told us that the sellers are still in their numbers. So we go down to weekly time frame. What we call this is top-down analysis to understand the flow of this market from the higher time frame perspective, right? So this is the weekly time frame. So the weekly time frame, what we come here to do is to plot down our major levels, major support and resistance levels, right? Here, we found a support and resistance, a very strong one, right? We have to delete this. This is a monthly time frame level. Yeah, we're going to be cloning this one. So we're cloning this one. Again, we are cloning this one. So what this market is telling us is that if price will be able to break this level, it's coming down to this other level. This is how market moves from zone to zone. But we are not going to be concentrated on these things, these areas of the market. These are bigger time frame. We don't trade on higher time frame. We make our analysis then go down to the smaller time frame to trade. Yes. So these are the levels of price. 0.8, 0.7, 0.6. Yeah. And 0.55. So this is our weekly level. Weekly level is telling us that price has left this area and is coming down. What are we going to do after plotting our levels? We go down to daily time frame to understand the most recent price movement in the market. So what is of recent? Well, already know that the flow of the river, the sellers are in numbers. So what is the recent thing that price did? Price actually created a little bit of an uptrend. Remember our lessons on identifying trends. So if you don't know, if you don't still understand how to identify your trend, you might want to go back to review the book. Everything is written well there. So after price broke this level, created a little bit of a level here, then came down to this level, pushed up a little bit. Now, price is trapped at this level. When it breaks down this level, it's coming down to this level. All right, this is how we know our take profit and stop loss and how we anticipate a lot of pips into the future, how we make our 1,000 pips and more in the market. So after identifying the recent price movements, now we are going to be looking at setups, right? We're going to be looking at setups. Our strategy, this is where our strategy comes into play. So here, we saw this level, price made another pick of the level here. So the next thing is go to the 4-hour time frame now. So now we've understand how the market has formed. And we know that what we are going to be doing is to sell. Any opportunity we see is sell. So this is now our strategy here. Remember, we say it is the banks that move the market. It is not retail traders. And these banks, they generate a lot of funds that when they, after trading, after every liquidity, there tends to be a volatility in the market. What is this volatility? Volatility are sharp movements of the market, either up or down. All these sharp movements creating bigger candles like this one, creating bigger candles like this. These are the banks making their moves, right? When they move this market, it means they have put a lot of money to sell this pair, or they have removed a lot of their funds from the market. Let's say they've been holding this price with $1 million. They decided to take away $500,000. This market will fall drastically, just like we've seen here with this big candle here. This is called a hammering candle. So they create this big bearish candle to take off their money from the market. So what we are looking to see now is when price will return to this level and tap on the liquidity zone for us to sell this market. And please don't worry about it. I'm going to be showing you a little bit of example how this strategy works and how it played out in the real time. Yes, let's see an example of what I'm trying to tell you. Okay. Yes, this is it. This is where our strategy played out rightly well. Remember, I told you that the banks create this big candle. Some people call it an institutional candle. Some people call it order flow. But as it is, they have removed a lot of their orders from the market, creating this huge move. And if you can see, this happened just in 4 hours. It took almost 1, 2, 3, 4, it took almost 24 hours to create this move from here to here. But fortunately, it took only just one candle, which is H4. It took only 4 hours to get down to this level. It means that the banks actually moved this market. So what do? We sit on our hands. We don't trade against the market. We trade in the direction of the bigger picture or the bigger trend, because the banks have understood that this market is going down and they have to take away their some of their profits from the market, some of their money actually from the market, creating this move after a little bit of retracement, right? So they sold from here after this correction move. So what are we going to do? As a retail trader, what we do here is, so as the market, anytime you see this move from the bank like this, all you have to do is just go there. Look at the previous candle before the big move. The previous candle before the big move shows momentum, the gathering of momentum, or should we say liquidity, from the both parties. Here, the buyers and the sellers are on constant struggle. So the last recent candle shows that this is where the weakness is, and this is where the movement occurred. So the banks always partition their movement into two. One is the first move. Second is to come back to fill that order. When price gets to that level again, it means that the banks are going to fill their unfilled orders. Don't worry, I'm going to explain this one better in the second video. All right. So what you have to do anytime you see a movement like this is to wait for the price to come back to touch this area again. So when price comes back to touch this area, what you do is you click your sell. So this is how, number one, we've understood where to trade with, which is sell. So everything we are going to be looking at this hedge 4 time frame is sell. So if you see any buy opportunity, we don't enter it. We always enter just when we see a sell opportunity, and this is where the sell opportunity came. So anytime price comes back to this level, all you do is what? Click your sell. Place your TP at where this price stops, right? Your TP should be at where this move stops. So let's see what's happened when price gets to this level. What's happening, man? What's happening to this view, man? So this is where the price began. As price tapped into this area, we sell and wait for a lot of profits to roll into our bank account, man. So this is how we identify the reversal points of the market. So this is what happened. As price entered into this zone, which is the liquidity zone, some people call it other blocks, some people call it liquidity area or POI, point of interest. So market gets to that level, and what happened? It pushed down. So it pushed down to a significant move. In forex, calculating these pips will get you up to from this level to this level. We are talking about roughly 100 pips. This is 90 something, roughly 100 pips. Just by seeing this move alone, gets you roughly 100 pips. before market goes up again. Yeah, and there are some criteria to note before trading this buy trading strategy. I'm going to list it out in the next video. So this is just a bit of an introduction. We go into details of this strategy. This is a very wonderful and amazing strategy that you wouldn't want to lose count on. And please, I'm always available on Fiverr. If you need an explanation, I needed you to give me a bit of a level of experience, but I didn't get that feedback from you, right? But if you want to ask any question regarding this strategy, I'm always there to answer you. This strategy has given me a wonderful way of trading or analyzing any markets, whether crypto markets, whether stock markets, indices, or commodities like gold. This strategy is a wonderful strategy. We are going to be seeing more examples and more explanations about the strategy. All right. So let's actually call it. It's a wonderful moment with me and my screen and you also. So let's call it a moment. We are coming back. I'll start with the second video and explaining in details what this strategy entails. Yeah, peace out.